Good evening. My name is Samuel Mbogwa, and I'm the one who will be taking you through financial reporting. It is exactly 5 minutes past the hour, and we have to start the class. So our first topic will be on accounts of insurance companies. And by definition, an insurance is a form of contract or an agreement under which one party undertakes to indemnify another party. And this term here, when we talk of indemnify, it means to compensate, or rather to protect or assure the other party that if they suffer any loss, they'll be compensated. And these losses could come from different or various, they'll be of various forms. So once they suffer the losses, then now the insurer or the party that is indemnifying the other party will consider to compensate the insured for the loss. Now there is some money that the insured or the party that is being insured will be paying. And this is what we are calling the premium. So the party undertaking to indemnify the other party, I've said, is called the insurer, whereas the party paying the premiums in order to receive the compensation or indemnity is called the insured. So kindly note those keywords. The agreement or the contract between now the insurer and the insured is what we call a policy. So the document that will contain the terms of the insurance contract is what we call a policy. So insurance is generally classified broadly into two categories. We have what we call the life assurance, and we have the general insurance. And as the word goes, life assurance is when you are insuring or you are seeking compensation for your own life. That's why we are calling it life assurance. For the general insurance, it will depend on the kind of risk that you are cushioning yourself against. For example, if it is loss of fire, you get fire insurance. If it is the risk of sea transport, that is to good and ship. Let's say you are shipping a container from China. You're going to get what we call the marine insurance. Accident, this is motor vehicle insurance or accident insurance. Then you could insure yourself against theft, burglary insurance. Then there's this we call the Fidelity Insurance. You're operating in an environment that is very risky. There's a fear that you might lose some of your vital assets. And assets could be either information or goods. Then you take what we call Fidelity Insurance. Then we have damage to third parties. That is third party insurance. So third party insurance could be coupled with the motor vehicle insurance, where the accident is either covering self or what we call the comprehensive, or it is covering the other party who will be involved in the accident, but was not part of the, he was not or she was not driving. Then we got the injury or sickness or death to workers at workplace. This is what we call WIBA, or the workman compensation. We have death. I've already talked about the life assurance, and could be loss of profit due to fire or natural causes. We are calling it consequential loss insurance. So different insurance companies have modified this product, but they mean one and one thing. For instance, if someone is cushioning themselves against terrorism, they might be having a product called terrorism insurance, but it falls under the category of consequential loss insurance. So that's how we broadly categorize the insurances. Now, I want us to have a perspective at the life assurance. And I said earlier, life assurance is taken against life, or the person who is being insured, the policy holder. So life assurance guarantees that the policy holder, after attaining a certain age or on eve of his death, he will receive a certain amount of money, and this will be paid by the insurer to the beneficiary or to them if it was a whole life policy. Now, throughout the period of the policy, the insured person will be paying the premiums. So life insurance is known as assurance. The reason why we are not calling it life insurance, rather we are using the word assurance, it is because it must be paid. So you are assured that whether due to death or at maturity, you are going to be paid or you are going to be compensated. There are those jargons that we normally use in life assurance. One of them is annuity. I know from business finance, you know, annuity is a regular payment that comes after a specific period of time. But in insurance, it is the annual payment which a life insurance office will guarantee to pay regularly, as long as one lives in consideration of the lump sum that is received at the beginning. So it is almost the reverse of the life policy contract, because the amount payable depends upon the age of the person concerned. And you are calling this person an annuitant. So the amount will continue flowing regularly, and this will be treated as an expense. Whereas the lump sum that this person paid, or the annuitant paid at the beginning, we call it consideration for annuities granted. So to the insurance company, consideration for annuities granted is an income. We always take ourselves as the business. So we are the insurance company. So the annuitant is an expense to us, right? They are a liability because we have to compensate them at maturity or death, whichever comes earlier. Then we have the whole life policy. And whole life policy is a policy that only matures on the death of the insured. So unlike annuity that is regularly paid, whole life policy will be put into consideration upon the death of the person who is insured. Then we have the endowment policy, and this is a policy that matures on the policyholder attaining a certain age. Most insurance companies will peg this age at 75 or 80. So what happens is, upon attaining an age of 80, the endowment policy is said to have matured. So you'll be compensated. If death comes earlier, you'll be compensated. That's why we are calling it an assurance. Then we have what we call the with profit policies. And as the word goes, when we are talking of the with profit policies, these are policies which guarantees to pay you on maturity. There will be a share of the profit of the life office to the insured person. What basically happens is, most insurance companies, they commingle the funds and invest them in different investment vehicles. These investment vehicles could be, for example, real estate. For example, Old Mocho UAP will get the life assurance from different members, commingle this fund. Of course, they are not dying tomorrow. And if they are dying, of course, there will be a reserve that can meet the people who are dying. So they are going to invest this amount in a certain investment vehicle where they are assured of a revenue flow. There is an income that they are generating from the amount that they received or the premium. So the profits could be shared now between the UAP old mutual and the insured. Then we have the without profit policies. Of course, this will be contained in the policy document, ab initio, or from the word go. Then we have the without profit policies. And these are those policies, as the word goes, that will have a fixed sum of money. So you already know that at maturity, after I attain 80 years, let's say, I'm going to be paid 10 million. There is no any profit that will come over and above the 10 million. That's why we are calling it the without profit policies. Then we have bonus. And bonus is the share of profit that the policyholder gets from the insurance company. If it is appearing in the policy document that the insurer has agreed that you are going to enjoy after they declare any dividends each year, you are going to enjoy a bonus, then it will be occurring every other time that the insurance company declares a dividend. Then you have the reversionary bonus. And a reversionary bonus in this case is when it is only payable at maturity. So what will happen is the insurance company will be declaring bonuses, yes, but these bonuses will be rolled over, or they'll be plowed back until your insurance policy matures. It is at maturity that you are going to be paid the bonus. That's why we are calling it reversionary. We plow it back, will be paid on maturity. Then we have bonus in cash, and this is what is declared and paid immediately. Then bonus in reduction of premium. Some insurance company will say, look, instead of you paying us, let's say the policy document indicates that you are supposed to be paying 10,000 every month, and they have declared a bonus of 2,000. What they'll do is they are going to reduce the premium by that amount. So you will be asked to pay 8,000, and of course 2,000 will now be catered for by the bonus. That's why we are calling it bonus in reduction of premium. Then we have reinsurance. Most insurance companies, of course, an insurance is a risk. So the insurance company is underwriting or undertaking a risk to indemnify the insured against a phenomenon. They can go ahead, because it is the risk, they can transfer this risk to another insurance company. And that's why we are calling it reinsurance. So they are insuring the risk with another insurance company. A good example of a reinsurance company is Kenya Re. You know Kenya Re? Kenya Re is standing on Aga Khan Walk. So this means that the insurance affected by an insurance company in order to cover itself against a large risk. A good example is, you can imagine the value of a ship. You could take marine insurance to cushion the goods therein, but the ship in itself is a vessel, and the owners of this ship have really invested. So what they can do is they are going to insure these vessels again with other insurance companies. So we are going to have an insurance company undertaking a risk of another insurance company. So for example, CIC Insurance is the one that underwritten, let's say, a certain ship or aeroplane, let's say. So they are going to insure the aeroplane with Kenya Re to cushion themselves against a certain level of risk. Then you have retrocession, and retrocession is where an insurance company reinsures one property with more than one reinsurance company. So I've said we have Kenya Re, we have East African Reinsurance. So CIC Insurance would also decide, instead of taking this risk only to Kenya Re, why don't I diversify? Because the cost of the ship or the aeroplane is huge. So they're going to reinsure the ship with more than one reinsurance company. That's what you're calling retrocession. So reinsurance is one, more than one is retrocession. Then you have commission on reinsurance ceded. So when a company reinsures some of the risk, the company receives a commission from the insuring firm. So this is what we are calling the commission on reinsurance ceded. So to the business is an income because you have received a commission because of reinsuring. Now, if it is us who are insuring, if we forego some commission to the company that is insuring their risk with us, we are going to have what we call the commission on reinsurance accepted. The opposite of commission on reinsurance ceded is commission on reinsurance accepted. So when our insurance company now decide to accept reinsurance premiums from another insurance company, we are going now to pay a commission. So this will be an expense. Expense will be debited in our revenue account. We are coming to that. Then you have surrender value. And surrender value is the amount that the policy holder can get immediately in cash from the life assurance company if they stop paying premium. Let's say you are supposed to pay premium for, let's say you insured yourself, you started insuring yourself at 40 years and the maturity is 80 years. Around 70 years, you decide to stop altogether. The amount that you are going to claim from the insurance company is what you are calling the surrender value. That amount that they are going to opt to pay you is the surrender value. Of course, there is some actuarials or calculations that will be involved because, again, this is a business. We don't allow free entry and free exit. Some insurance company will say, if you've serviced your policy for a duration of more than 10 years, we are going to charge you, let's say, 5%. If you've serviced your policy for 20 years, let's say 1%. So the more, the merrier. Then you have the paid up. And in this case, the insurance company doesn't expect any further premiums. So at 80 years, when it is mature, it's maturing, the insurance company is optimal. So the policy amount is now proportionately reduced to the number of premiums paid, having regard to the total number of premiums that are paid. So this will mean we let now the insurance policy take its natural course of action. It will mature. Then claim. A claim means the amount that is payable by the insurance company. And the reason why you are insuring yourself, for instance, if you get an accident, and I'm trying to digress for purposes of example. So this is an analogy. If you had insured yourself, let's say against if you had taken a comprehensive cover on your vehicle, and the comprehensive cover is supposed to be, once you get involved in an accident, they give you 100,000 and they give you a courtesy car as they repair your car if it was not written off. Let's assume a scenario where you've just been hit and run. So the person who was involved in an accident just hit you and ran. So you document, you go and claim to the insurance company. They are going to pay you if indeed you're on the wrong. So what normally happens is the liability is taken over by the insurance company once you are involved. So when we go now to the life assurance, upon death, the insurance company, your beneficiary will claim. So it is the amount that is payable on your death. So if the claim is paid upon the policyholder attaining the age, because he said he is either death or maturity, let's say it was at 80 years. God willing, you have attained the 80 years, you have good health, but your claim has, not your claim, your policy has matured. Whatever you are going to get is called survivance. So claim is upon death. At maturity, we get what we call the survivance. There. Now, the annual accounts of the life assurance company are two. We have what we call the revenue account, and we have the balance sheet or the statement of comprehensive income. I've shared the format. Now, this is the horizontal format. And horizontal format is for purposes of understanding. Otherwise, we adopt the vertical format. So for examination purposes, you will not be using this. This is for understanding, where you know that all the items that are appearing on this side, on the debit side, they are expenses. But what is appearing on the credit hand side, these are revenue items. Are we there? I want to stop sharing this and share the format of the revenue account. Revenue account. So this is the revenue account. I will explain some of the items, but for purposes of understanding and just explain. I've said that the items that were appearing on the credit hand side are the incomes, and the ones that are appearing on the debit side are the expenses. So we start with the life assurance fund, this amount here. Now, life assurance fund, this is the balance brought downward. Of course, we assume that the insurance company is a going concern. It's an ongoing business. So this is the fund that you are going to have at the beginning of every year. We've assumed 2021 is just concluded. We are in the year 2022. So whatever we closed our books with in the year 2021 will be at the beginning or appearing in our revenue account as at the beginning of the period. So this is the fund at the beginning of the period. I've said is a credit balance. Then we have the premiums received. And premium, I've said premium is the amount that we are going to be paying depending on the agreement in the policy. Could be monthly, could be quarterly, could be semi-annually or annually. There are those people who will pay even for 5 years upfront. So the premium received during the accounting period is what we are going to consider, plus any outstanding at the end of that period, right? Then we are going to less any premiums that was paid for insurance. If your risk was transferred to another insurance company, because we'll be having an example and we'll see. So those are premiums. Then I said what consideration for annuities granted are if we reinsure our risk with another insurance company, whatever the commissions that we are going to receive is what we are calling the consideration for annuity granted. So it's an income, and that's why it's appearing on the credit side of the revenue account. Then we have the interest received, less withholding, dividend received. All these are incomes. So in the life insurance company, we have the diversification. I'll say that the insurance company may decide to invest this money in an investment vehicle. For example, a building where they are accruing or attracting some rent. So what will happen is, as at the end of the period, you are going to recognize all these, incomes. And then the interest that we may receive. If you are investing, let's say, in mortgages, we have the mortgage interest. If you are investing in shares, we are going to get the dividends. Then fines for getting lapsed policies revived. There are instances where maybe, for example, we were hit by Corona in the year 2020. Most people, of course, were hit underbelly, and therefore their disposable income was affected. If you are such a person and you had stopped paying for your policy and you start paying again, let's say after 9 months, the Corona hit in mid-March. Let's say from April all the way to December 2020, you didn't pay. You resume in January 2021. You're going to be paid, of course, charged some fines because of not paying for some time. That fine will be an income, of course. Then we have any other income that you are going to receive. Then there was registration fee. To avoid now people, the walk-ins, Kenyans and their behaviors. You can just decide to walk in UAP, Old Mojo, or CIC Insurance and ask questions. To commit, even at ZTEC, they'll ask you to pay some 500 shillings via ACB and PESA. Now, this is to cut the queue of the people who are just coming for, the walk-ins. That's an income in a way. And then we have so the registration fee is an income and it's supposed to be shown on the credit side. Then we have the commission on reinsurance business ceded. Now, when you are talking of the commission on the reinsurance business ceded, I've said this is when we are the people who are giving the reason why I've put it as star is because we are the ones now who are paying the commission. You'll see how it is treated. Let's save that for the illustration. Then I have the expenditures. Of course, you have the claims. Of course, if people are hit by the risk that they were underwriting, of course, you are going to pay them. So a claim, I want people to note the treatment. So we are talking of claims including outstanding claims, less claims recovered, and recoverable from the insurance company. So a claim, I said earlier, is any amount that is payable to the insurance company. So in life insurance business, the claim may arise due to two reasons. Could be either death or maturity. So when you are calculating this figure, all the claims that were intimated and accepted, or they were, when you are closing the year, there are those people who will have applied and we are not yet accepted, but we later on accept, right? Or they are not accepted as at the end of the year. We are going to add any expense that will be incurred when we are processing. Of course, we are going to call it a claim. Like when we are talking of the value of asset, the historical cost, any cost involved, carriage insurance, shipping cost, excise duty, import duty, everything falls under the category of the cost of the asset. Same thing to claims. So any expense that is related to this claim is added, and then out of the total claims outstanding at the beginning of the year, we are going now to deduct the reinsurance recoveries. That's why I'm talking of less premiums paid for. That's why I'm talking of the less recoverable from the insurance company. Then you have the surrender value. Now, surrenders, you say that if the insured is unable to complete the term of maturity, or if they are unable to pay until maturity, you may consider refunding them. So that's the surrender value. Then we have annuities paid and due. And you say that this is the annual payment that the life insurance company guarantees to pay for a lump sum. So this is what will be received in the beginning. Then you have bonus paid in cash. You say this is what is declared and paid immediately. So if the insurer has with the profit policy, he'll get the bonus from the corporation or the insurance company. If the bonus is paid immediately, then this is an expense that the insurance company has to write in the revenue account. Then we have the bonus utilized in reduction of premium. You said instead of paying bonus in cash, the insurance company may deduct the bonus from the premiums due from the insured. That's why we are calling it the bonus in reduction premium. So it will be shown both on the very keen, the bonus, this item will be shown on both the debits and the credit side. If I take you back, stop sharing. I want to take you back. So you can see this item here. Bonus utilized, and it is here. Why is it? Is it not appearing? Now, what I'm trying to say is that the is on the debit side because it's an expense, and on the credit side, we normally show it by adding to the premium of the revenue account. It's supposed to be added here. I'll show that when we come to the examples. Not indicated here. I think I need to indicate it for purposes of illustration. For that, that's noted. But kindly note that it appears, I'll show you, it will appear both on the debit and the credit side. Then expenses, we have the commission to agents. Now the insurance business has brokers, like the securities exchange market. You cannot directly go to the floor of the Nairobi Securities Exchange and buy shares. You have to go through a broker. Same case to insurance business. For your risk to be underwritten, you have to come through an agent. Now, these agents command some commission because of the businesses that they are bringing to the insurance company. So these are like your advisors. They are the ones who will give you the best deal or advise you and help chase for claim whenever you are hit by the risk. So we pay them commissions. We have the other expenses. Of course, we have employees of the insurance company. We have salesmen. We have those people who are trying to move to get businesses. We have the management fee or the expenses that is paid. So the expenses of management are combined, and they consist of any cost that will be incurred by the directors when they are trying to close on a business, right? We normally combine them and call them expenses of management. So when you are seeing the director's fee, traveling cost, whatever, I've just broken down. Then we have the other expenses, indirect expenses to the business. Of course, these are the ones that we pay. And of course, we have to meet the regulatory. That's why I'm talking of the taxes. Taxes will be of different nature. Be having withholding, could be having the corporate taxes, etc. as they come. So you can see we have the commission on reinsurance business ceded, and then I have here commission on reinsurance business accepted. I said when we cede, it is an income. When we accept, it is a liability. Of course, any other expense that we are going to incur. So as at the end of the day, whatever we are going to report here is now the life assurance fund that will be carried downward. Remember, people are still dying, their policies are maturing, and they are still claiming. In other words, I'm trying to say, we don't have profit in the, we don't report, professionally speaking, you cannot make profit out of health or life of an individual. It's like the hospital, and that's why hospitals are not for-profit making organizations. So we are trying to be courteous here, but we are in business. So whatever we are going to take over to the next period, this is the life assurance fund that will be carried downward. And this amount is so significant because it's what will be taken to the balance sheet to ensure that our books are on the safer side. What you are supposed to note is the expenditure side cannot be more than the income side. Otherwise, you will not be in business. Otherwise, you will not be in business. So that is the revenue account. Then we have the statement of financial position. Allow me to share the statement of financial position. And the statement of financial position is the balance sheet. You are accounting students. Statement of position. Very well. It is here. And we know that the statement of financial position is supposed to report the assets and the liabilities of a company as at a certain position. So that is the illustration. I said that before I forget, just like any other business, insurance business will have what you call the bad debts. Of course, there are those customers who will be doubtful at some point, and that's why you are charging them fines when they revise their policy. But suppose a customer goes and they never come back, you have to provide for that bad debt, isn't it? So what you are supposed to know is that our life assurance fund will be the difference between the credit and the debit side. But any business will always aspire to report a profit and not a loss. Are we there? Are we there? So the difference between the credit and the debit side is not profit, is life assurance. But you should make sure that it's a positive figure. Are we there? That figure is what you are bringing here in our balance sheet for it to balance or behave otherwise. So in our asset portfolio, I've said the insurance company might decide to invest or diversify their portfolio in different investment vehicles. Could be mortgages, policies, stocks, shares, etc. They could invest in government securities, government guaranteed securities, bonds, debentures, all manner. Is a diversified portfolio. What they make sure is the portfolio is optimal. Optimal to mean there are some liquid assets because of the compensation or the claims upon death. So they should make sure that there are those that are near cash equivalent. And of course, there are those that will go into the other long-term investments like mortgages. Of course, the actuarial scientists will have advised them on the decision model on the portfolio that they are going to retain. Then you have the agent balances. And this is, I've said that customers are brought through brokers, whom we are calling agents. And these agents, we pay them commission. So whatever remains, of course, is an asset to the company. Then you have the accrued interest, dividends, and rents. Remember, the tenants of accounting are still remaining. So the accrued interest or accrued incomes, we are treating them as assets. Prepaid expenses are being treated as assets. Prepaid income are treated as liabilities. Accrued expenses are being treated as liabilities. Kindly note that. Then you have the amount due from other insurers. We have the bills receivable, sundry debtors, bank, cash. That will give us the total assets. Then, of course, we have the liabilities. And in our liabilities items, we have any obligation that the insurance company has to meet will fall under the category. So I have the share capital issued and paid up, investment reserved. Of course, we are going to have due to the nature of the business, we should have retained earnings to make sure that whenever there is a risk that we need to meet, and that's why we are talking of the life assurance fund that will be carried downward and then be brought downward, is to ensure that whatever the nature of the risk that we are covering, there are funds just in case there is a claim that will be brought our way, we'll be able to meet. That's an obligation pending. So we have the funds from other businesses. Of course, we expect that the insurance company is not just dealing in one product, the life assurance, though they have other different categories of risk. Fire, marine, could be accident, could be consequential, any other business that they are involved in. And there is a capital or owner's equity that had been put there. Then the debentures, you have the certificates that we have lent or we have received any liability or any debt to support our business, that is. Then we have the other liabilities, and these are all the bills payables, any claim that you are processing but not paid, annuities due but they are not paid, outstanding dividends. That's why I was talking of now the accrued. Any accrued income will be falling in this category. Then we have the premiums received in advance. We have so any prepayment will be falling under the category of the liability. Then we have the sums due to other insurance companies. Remember the ceded and the granted. Granted is when we are receiving as an income. Ceded is when we are paying or allowing a risk of another insurance company. Then we have the sundry creditors, etc. All the other liabilities that are in business in nature, any accrued expenses, contingent liabilities, name them. So this total to the liability items and the capital items, and they should balance with our assets. So our total assets should balance with our total liabilities. They have an illustration that we are supposed to undertake. So I'll take you back. I have an illustration. I need to make sure that this is what I'm sharing. The explanation, I think I had given all these explanations. So you can see even the balance sheet, we are putting it on the horizontal format for purposes of understanding on the items that are debited and what is being credited. But ultimately, we'll be using the format that I've shared. I have an illustration here, illustration 1, and I've shared this in the portal. We've been told that the following balances were extracted from the books of all people assurance company. We've been given all these totals: claims by death, claims by maturity. So I'll expect that you'll go through the illustration. Yeah. So all that you need to know is which items are of income nature, which one are of expenditure nature, because this is what now will guide you into doing the revenue account. And the purpose of doing the revenue account is to get the life assurance carried downward, because that's the figure that will be taken to the statement of financial position. I've realized no one has logged in this class. So for purposes of learning together, I'll end it at that point. We pick from that point in our next class. Enjoy the reading.